defense and infrastructure spending, and reforms to enhance productivity and complete the single market, as well as euro area firms adopting new technologies, may drive up growth by more than expected. The risks to the inflation outlook are to the upside. The energy shock could intensify further, and its effects on other prices and wages could be stronger than currently expected. The longer energy prices stay high, the more likely they are to drive up broader inflation through indirect and second-round effects. Ongoing trade tensions could give rise to more fragmented global supply chains, curtail the supply of critical raw materials, and worsen capacity constraints in the euro area economy. Extreme weather events, as illustrated by the ongoing heat waves, and the unfolding climate and nature crisis more broadly, could drive up food prices by more than expected. By contrast, inflation could turn out to be lower if the conflict in the Middle East was resolved sustainably, or if indirect or second-round effects proved less pronounced than anticipated. More volatile and risk-averse financial markets could weigh on demand and thereby lower inflation as well. Overall, financial conditions have become slightly tighter since our previous meeting, consistent with the increase in the key ECB interest rate. Bank lending rates for firms and the cost of issuing market-based debt remained unchanged in May at 3.6% and 4% respectively. The annual growth rate of bank lending to firms increased to 4% from 3.4% in April, but this was partly offset by slower growth in corporate bond issuance, which fell from 4.5% to 3.4%. Credit standards for business loans tightened somewhat in the second quarter, as reported in our latest bank lending survey for the euro area. Demand for loans to firms increased slightly, driven by higher working capital needs, but also by borrowing for fixed investment by large firms. Mortgage rates rose to 3.5% in May, after 3.4% in April, while mortgage lending growth edged up to 3.1%. Credit standards for mortgages tightened in the second quarter as banks became more concerned about the economic risks faced by their customers and less willing to take on risks themselves. Demand for mortgages decreased on the back of deteriorating consumer confidence and higher interest rates. So in conclusion, the Governing Council today decided to keep the three key ECB interest rates unchanged. We are committed to setting monetary policy to ensure that inflation stabilizes at our 2% target in the medium term. We will follow a data-dependent and meeting-by-meeting approach to determining the appropriate monetary policy stance. Our interest rate decisions will be based on our assessment of the inflation outlook and the risks surrounding it in light of the incoming economic and financial data, as well as the dynamics of underlying inflation and the strength of monetary policy transmission. We are not pre-committing to a particular rate path. In any case, we stand ready to adjust all of our instruments within our mandate to ensure that inflation stabilizes sustainably at our medium-term target and to preserve the smooth functioning of monetary policy transmission. We are now ready to take your questions. Thank you.
First question goes to Annette Weisbach of CNBC. Annette, please.
Good afternoon, President Lagarde. My first question goes onto the discussions which you had today. So just to get an understanding of how you have discussed the recent spike in energy prices and what it also means for policy setting going forward. I know you don't want to pre-commit, but still the communique and also what you're saying today, at least in my understanding, reads rather to err on the side of being more vigilant about the price development. My second question would be on, have you discussed the rise in bond yields? Because they are also increasing. And do you factor that into an assessment of how tight monetary policy is actually here in the euro area? Thank you.
Thank you very much for your two questions. So we spent the last 2 days with members of the Governing Council really looking at all the data available and assessing the situation since the last monetary policy decision that we made back in June. And I'm saying back in June because there's a lot of back to the baseline in the situation that we are facing at the moment. So the analysis that we conducted, fed by staff work analysis, really looked into what has happened since June and what policy decision should we make as a result. So since our decision in June, we have had some relatively benign development. You look at inflation, which came out much lower than anticipated, 2.8 versus 3.2, difference relative to our anticipation. You look at economic activity, taking out Ireland, it's a relatively good progression, 0.3. And then, of course, the Memorandum of Understanding, which preceded a ceasefire, which led to significant decrease in at least crude oil prices, probably faster than we had anticipated. But that was the first part of that period of time. Then came the second part, where this Memorandum of Understanding was short-lived, ceasefire was broken several times and led to the current situation where we have clearly a flaring up of the conflict and serious development taking place on the commodity markets. So that's what we considered throughout the last 2 days. And we really applied the method that we have agreed amongst ourselves in such a shock, which is to really try to understand the density, the durability, and the propagation effects of the supply shock. That's what led us to take the decision that we took this morning of holding our rates for the moment. You asked me about the euro area bonds. You know, we take at a certain point in time, because there's a cutoff date at which we stop the clock, if you will, but we take all market conditions, including, of course, the euro area bonds, their evolution in that process. So this is part and parcel of, number one, the baseline, and number two, the assessment that we take on the occasion of this meeting. There is one difference that I'm sure you have noticed, which has to do with our risk assessment. When I say we're back to the baseline, we're also back to the risk assessment that we conducted back in June. And if you remember at our conference in Sintra, I did refer to more balanced. I didn't change the direction, but I used the reference to more balanced upside and downside risk, respectively, for inflation and growth. That segment, more balanced, has been removed. And obviously it reflects the succession of the embellie, if you will, that we had for a couple of weeks, and then again the flaring up of the conflict and the impact that it has had on commodity prices, and as a result the expectations that we have in relation to prices.
Francesco Canepa of Reuters. Francesco, please.
Good afternoon. So was the decision today unanimous, or did anyone, even at the discussion phase of the meeting, raise the prospect of increasing interest rates? Second question is about the indirect and second round effects that you mentioned in the press release. Can you tell us if you see any evidence of those materializing?
Well, thank you for your two questions. Yes, it was a unanimous decision. But I'm going to qualify that because there were some governors who asked themselves whether we should not consider a hike. In other words, raising the 3 interest rates on the occasion of that meeting. And we had really a good, thorough look at the data, at the current development, and we all unanimously decided that we were positioned adequately to wait and be very attentive in the next few weeks to the development of the situation and to the data that we will be receiving in the next few weeks. Consider that before our next September meeting, we will be receiving 2 monthly indicators for inflation. We will be receiving the GDP for the second quarter. We will be receiving 2 consumer expectations indices. We will be receiving 1 CPE, compensation per employee number. We'll be receiving 2 PMI numbers. I'm going through the long list, sounds like a laundry list, but that's just to give you an indication of the volume of data that we will have and the scope of indications that we want to absorb in order to apply reaction function. So we will be receiving all that. We will be looking very carefully at all these data. We will be applying our normal reaction function, inflation outlook, the risk associated with it, the underlying inflation, transmission, and we will be again measuring, the intensity, the duration, and the propagation of the shock throughout the economy. And that takes care of your second question. We will be particularly attentive to any risk of second-round effect. I think it's clear to all of you, all of us, that there are direct effects. It goes without saying. That there are indirect effects when you look at the price of, say, transportation, for instance, pretty obvious. Second-round effects, we are not seeing it. So, believe me, we are really scrutinizing the emergence of second-round effects, but we are not seeing it. So, one of the most up-to-date, informative element that we have is the corporate telephone survey, where we ask large and smaller corporates, what are your plans in relation to wages? And we are not seeing second-round effects. There might be compensations on a one-off basis, for instance, but a change from what is naturally incorporated in our baseline, no, we don't see that. And on top of it, what we had anticipated, which was this gradual decline of wages, we are seeing it. I mean, compensation per employee is one indicator, went from 3.8 to 3.5, but we also have the wage tracker. We have the negotiated wages, which is also informative about what is to come. And none of those elements, for the moment, are giving us second-round effects indication.
And now Jana Randor of Bloomberg. Jana, please.
Good afternoon.
Good afternoon.
So I heard you say some of your colleagues wondered whether we, or you rather, should already raise interest rates today. You said on another occasion that we decided to hold rates for the moment. Now, I'm just going to go and conclude that this sounds very much like you are preparing and signaling a September hike, and I very much invite you to say if that's not the case. But my real question is, what would need to happen for you not to do that? What would need to happen for you not to consider a September rate increase? And my second question is of a bit of a different nature. You keep feeding speculation that you will leave the ECB early. You've talked about clouds on the horizon. You've talked about captains and ships in crises. I'm really just looking for a yes or no answer today on whether you're willing to commit to serve until the end of your term. Thank you.
You know, I hate to be boxed in any particular circumstances. So on this latter point, number one, it was not discussed at the Governing Council meeting, but I'm going to give you two elements. First of all, you are not going to see the back of me before 2027, okay? And second, what I said, that 2027, my dear, okay? And the second point that I would mention is the same that I did mention once. When there are clouds on the horizon, the captain stays on the ship. And this captain is staying on this ship, as long as there are clouds on the horizon. Now, you can speculate, write anything you want. I don't think it's particularly interesting and important. What matters is that we apply the right monetary policy in order to bring price stability. So that will be my answer in response to this point. More importantly, what we are doing is not giving any forward guidance. I think that, you know, I've made that point clear and loud, and I've been doing that for a long time. On the other hand, we are giving framework guidance. So analysts, you all appreciate how we assess the situation, what elements we take into account. And it's a combination of the three-prong approach, which is underlying inflation. I'll cut it short because you know it inside out as I do. Underlying inflation, transmission. But we also, and I think I've made that very clear in I think it was the ECB Watcher speech, I gave clear indication of how we assess the situation in case of an energy shock of that nature, whether it's short-lived, whether it's longer term, whether it's high and long. And I think that all of that stands. Okay, so we do that. We also, and particularly in light of the most recent variation of and volatility of prices, we also take a view on the duration, the intensity, and the propagation of the shock. And it's really on the basis of all those parameters that we make decisions on a meeting-by-meeting basis. As I've said, we back to the baseline. That stands. We are going to continue to receive all these components and all this data in the weeks to come, and then we will make our decision in September. Thank you.
And the next question goes to, sorry, I have a blank, Olaf Storbeck from the Financial Times. Sorry, Olaf, over to you.
Thanks for taking my questions. My first question is regarding the current today's situation in the Red Sea. Did you discuss that in the Governing Council meeting and what it might mean for the overall assessment if now a second key supply line might be disrupted? And my second question is, actually I only have one question today.
This is a bit of a change. So, we have seen multiple developments. As I said earlier, in the last 6 weeks, we've seen improvement, positive expectations, significant reduction of prices, followed by negative breakthrough, significantly increased prices. And by the way, we look not just at crude oil, we look at all the variations of that, including the what is known as the crack spread, to see, you know, where money is actually going in case of price increases. The most recent developments, I'm assuming that you're referring to the Houthi threats against Saudi Arabia vessels and the materialization that took place this morning. My understanding of that is that it was reported at 10 a.m. Now, because it was a decision that harnessed a great sense of consensus around the table, we probably finished the meeting at about 10:15. So I'm not sure that that particular element that took place this morning, which is alarming, which is clearly going to have an impact and is having an impact. We can see that on the price of Brent as it evolves almost by the hour. But that was not in and of itself taken into consideration during the decision that we took this morning. That does not say that we are oblivious to energy shock that last, that possibly amplify, and that certainly have repercussions. And so we are very attentive to that. I can already tell you that we asked staff to conduct some really in-depth analysis for our September meeting on the various oil prices, as I just mentioned, but also gas. Because when you look at energy prices, oil has certainly gone up and is going up as we speak, but gas has significantly increased as well. And given the level of inventory that is at rather low levels, this is also a matter that will be under sensitivity review. In addition to the scenario work that we do, given the magnitude of changes that are taking place.
Next question goes to Stefan Reccius of Handelsblatt. Stefan, please.
Thank you and good afternoon. I'm trying to poke a bit more on, what's been discussed on potential hikes. Given that there was some sort of push for a back-to-back front-loading type of hiking today.
No, there was no push.
Push is the wrong word. Okay, fair enough.
Wrong word.
Who has the burden of proof going into September? Is it on those arguing for a hike, or is it on those arguing against a hike? And my second question is on the minimum reserve requirement. Did you have any discussion about raising it, and or will it be open for discussion in the next month? Thanks.
So my answers will be rather short. The burden of proof is on data. As simple as that. On the minimum reserve requirement, it was not discussed on the occasion of this Governing Council, which doesn't mean to say that it will not be discussed. It will.
Next question goes to Andres Stumpf of Expansion. Andres, please.
It will, as it has been, by the way. This is not something that is,
Thank you. I would like some clarification on the alternative scenarios. Given that you are willing to give some framework guidance, is there a point at which the mild scenario is no longer a possibility, even if the conflict ends? And could that point be reached in between today and the September meeting? And a second question, if I may. How are you planning to balance the agility of the central bank with avoiding sudden shifts in direction? Because 2 weeks ago, we had a completely different situation, and that could have needed a completely different monetary policy decisions, right? Thank you.
Your first question deals with the sustainability of the mild scenario, right? Or the likelihood of materialization. It's not a question to which I can give a reliable answer. Why do I say that? Not because I cannot think, or the staff cannot help us think along those lines. But we have seen so abrupt changes occurring in a matter of days, not just in terms of the level of the conflict, but also the consequences in terms of energy prices. Remember how fast energy prices went down after the announcement of the Memorandum of Understanding. Now, once burned, twice shy, it could well be that another announcement of such Memorandum of Understanding will not have the similar impact, because there is rising uncertainty, and it applies across the board. But still, the situation can reverse so fast that it's difficult to, either affirm or challenge the possible materialization of this mild scenario. As we stand now today, it looks quite unlikely. Let's face it. But Taking a view on the likelihood of materialization is another story because of the uncertainty that we have. And that's precisely the reason why it is helpful to have the scenarios and to test our recommendations and our stance against all scenarios and to have a range of assessment. I'm not sure exactly what you meant about our agility, but what I can assure you of is that staff at the ECB is working flat out to absorb all the data almost as they come and to make sure that while sticking to principles of cutoff dates, of the reaction function that we apply, they are still capable of absorbing all developments. And that's really a factor of the agility that we try to demonstrate. We've done that in the past, and we will continue to do so. Thank you.
Next question goes to Santi Pignol of Market News International. Santi, please.
Good afternoon. My question is, with all these developments that change quickly, I think it's particularly important that markets understand this framework guidance. Do you think that they fully understand the guidance framework and the reaction function? And I'm not asking if they are pricing right, but do they understand what you are saying in a moment where things can change so quickly? And is there a way to improve that understanding? Thank you.
Well, thank you very much, because this is a question that we asked ourselves as well. And our assessment on the basis of the transmission and the almost immediate transmission, the tightening that we have observed on markets, our understanding is that our reaction function is very well understood by markets. The fact that it has been well articulated, that it's concise, its expression, that it can be understood, I hope, by all, but certainly by markets, I think is a factor of stability in this very, very uncertain landscape in which we are trying to navigate. So I really think that it is well understood. And, analysts, markets, you have access to a similar range of data as we do and as they are published. So the integrity of the data is important. The immediate assessment of such data and taking on board of such data is important as well, but the reaction function is something that is very stable.
Next question goes to Elena Satova of the Bulgarian news agency BTA. Elena,
thank you for having me. Speaking of inflation, one of the countries with high inflation in the recent months is Bulgaria. How do you access this data? And I have a second question that's somehow interconnected. How do you assess the outlooks for Eurozone enlargement, given the signal that are coming from Hungary? Thank you.
Thank you for your two questions. You are correct that Bulgaria is currently experiencing a high price level, high inflation. And that may have to do with the fact that some prices that had been kept on hold for a period of time have found their way into the markets. It's not totally unusual, and we always have divergences between member states. I think what matters is the commitment of Bulgaria to observe, sound public finance and to make sure that inflation returns to more acceptable levels, in particular for the Bulgarian population. So we monitor the overall euro area, but we are attentive to divergences, and this is clearly one of them at the moment. On the issue of enlargement, this is a topic that is not really for us to decide. It's a matter where we give views, particularly in relation to inflation. It's a matter that is essentially under the consideration of the European Council and the Commission. As you know, there is a process. Bulgaria went through that process successfully, and we are, always ready to welcome more members as long as they satisfy the requirements and comply with the criteria, and the convergence conclusions is positive. So we'll see. It always, as you know, it always takes a little bit of time. But ultimately, all members of the European Union, except for one, are expected to join the euro area.
And the last question today goes to Marta Villar of Econostream. Marta, please.
Very much. Good afternoon. Thank you for taking my questions. Madame Lagarde, would concern about second round effects alone justify another move in September, or would you need to see evidence that they are in fact materializing? And my second question is about the market implied rate path. You often point to the rate path embedded in the staff projections. How important is the market implied path for policy decisions? Thank you.
So if it was just a matter of concern, we would have raised hike. Because whenever there is a shock of that nature, we have to be concerned about direct, indirect, and second round effects. So we are concerned, which leads us to be being very attentive, looking and sort of checking any possible emerging sign that second round effects are not only in the making, but in the coming, and more so than what we have in the baseline. We are not at that stage where we are seeing those emergence sign of second round effects. Okay? Additionally, by the way, we have inflation expectations beyond the short-term ones that are broadly anchored at our medium-term target, which is also important. The rate path implied, that is market determined, is something that we factor into our work, because obviously we take certain market conditions at a cutoff date, and that includes, of course, the market rate implied trajectory. Thank you.
Thank you. That concludes our press conference.
Wait. I want to say something.
Okay.
Now, I want to say something because I don't know if we still are on the stream or not, but I just want to take this opportunity to congratulate the Central Bank of Bosnia and Herzegovina, as well as the Central Bank of Montenegro, on their successful launch earlier this week of a platform for the settlement of instant payments, which uses the technology of TIPS, the Eurosystem's fast payment system. We don't often talk about that because it's a monetary policy-focused press conference, but this is important. So I'm looking forward to a similar launch in Albania, Kosovo, and North Macedonia, which are expected to join in November, bringing all countries participating in the initiative onto the platform. And I would like on this occasion to thank Banca d'Italia for the key role that it has played on this initiative on behalf of the whole Eurosystem by developing a clone of TIPS for the countries of the Western Balkans, which, except for Serbia, are now all going to be included in November within our TIPS platform. You should expect some further development in relation to interlinking fast payment systems, but that's for a later date. And I know that some of you are going to stay a little longer, maybe writing the articles and news, because we will soon be disclosing in that very room the set of proposed new banknotes, the new euros that will have a different face, a different back, and that will be in the pockets of European citizens when the project is completed, after hopefully they have participated in the survey. With that, I hope to see you in about half an hour.
That will be at 4:15, and the next press conference will be at our External Governing Council in Berlin on the 10th of September. Thank you very much, and see you shortly.
You have been watching the ECB press conference from ECB President Christine Lagarde speaking in Frankfurt following their decision not to change rates. You're watching Bloomberg Open Interest. I'm Danny Berger along Isabel Lee. So yes, it was an ECB that decided not to change rates, saying that a full impact of inflation, of an energy shock, has yet to play out. They're not seeing any second order effects, but Madame Lagarde there pointing out that she was concerned that we might see some. There was no push for an ECB rate hike, according to Lagarde. Lagarde, but some governors asked themselves if a hike was needed. Worth just quickly saying the background of what's happening in markets, because markets are open. Alphabet getting hit hard in today's session. Isabel Lee, not helped by maybe hawkish expectations for central banks given oil at triple digits.
Not help at all. You see shares falling more than 6%, erasing $265 billion, Danny. We have a lot of tech earnings to digest. I'm pretty excited. We have Tesla, Alphabet, and a whole slew. Even American Airlines. I mean, you and I travel a lot, so
yes,
definitely in our interest.
You are excited, but the market is maybe disappointed. But first, it needs to wrap its head around the macro backdrop. Let's bring in Seema Shah, Principal Asset Management Chief Global Strategist. Seema, we just heard from Madame Lagarde this idea that we haven't fully seen the second-order effect. She's nervous that we will from higher energy prices. We're feeling it today. Triple-digit oil, $100 a barrel for the first time since May. At the same time, yields rising after in the U.S. we saw the lowest jobless claim since 1969. Is this a market that should be bracing for rate hikes, both from the ECB and possibly from the Fed next week?
Hi, Danny. Well, look, I mean, just looking at the data, looking at the way that the market is moving, oil prices are moving today, certainly suggests that the ECB is online to have another hike in September, potentially one after that as well. So she's being quite careful and cautious with her comments. But certainly, as she noted, you know, the mild scenario seems very unlikely given the latest developments. So I think we have to put a lot of weight on that. When it comes to the Fed, I think it's a little bit more ambiguous. Certainly, we are expecting at this stage that the rates are going to stay on hold through this year. But the odds of a rate hike are increasing with each additional day that these tensions persist and oil prices stay higher. Because, of course, just like Lagarde said, it's the same thing for the US. Second round effects are the real concern. So that's the key thing that we'll be watching out for. But next week, we don't expect any move.
Seema, what does it mean then for risk assets when you do have two-year yields at the highest since 2025? Sure, we don't expect, or you don't expect a move for next week, but might we be getting to a level even with longer term yields that have been sticking above 5% for the 30-year yield for the longest stretch since 2007? Does that do something to risk assets this morning?
Yeah, look, these are really good points. So far, markets have dealt with this pretty well. And I think one of the things that we've been seeing is, you know, even over the last couple of months, when oil prices were higher before they went back down again, we did see that the economy dealt with it fairly well. The real concern was around how the Fed was going to respond. And I think that's what you're seeing with yields at the moment is, of course, they're worried that the Fed is going to be responding within the next month or two with rate hikes. If they did do that, and you were to see this continuation push higher in bond yields, then of course it's going to be a really difficult situation for the equity market. So far, it's really resting on earnings growth. That's what's been propelling it. But once you do get rate hikes, particularly if the market expects it to be the first in a sequence of hikes, that's where the arithmetic gets more challenging. So I'm not surprised by the market being down today. Question is how the Fed responds, and if you do get that rate hike that the market is currently pricing in.
All right, Seema, hang tight for just a moment because let's get a check on where that market is today, because we are 6 minutes into a trading day. We opened up markets in the midst of an ECB conference where the ECB didn't change rates, but still Christine Lagarde expressed concern that we would see second order effects from higher energy prices. And that's what you're seeing today. We're back under $100 a barrel, but not far there under. That's weighing on yields with your 10-year yield at 4.7. It's not just that. It was also the macro data with jobless claims coming in the lowest since 1969. Not helping things either, Isabel, is what's happening in tech after Alphabet earnings down 1.4%. So what are some of the single name individual stocks doing now?
I think first of all, we have Google. I wanted to say that the tension between what shareholders want and what AI demands is really going to be key. So, I mean, Google raised their Capex forecast to as much as $205 billion this year. That's fueling concerns over the sustainability of the really massive spending on AI. You see the stock there down by nearly 6%, Danny. And
you also mentioned we had Tesla reporting after the bell. Disappointing profit despite a strong quarter for its automotive business. That has pressured CEO Elon Musk's plans to refocus the company on AI and its Optimus robot.
And we also have IBM cutting its full-year sales outlook after seeing a dip in demand for its mainstream business. But some analysts are saying that the report was better than feared. You see the stock there also down 2%. It seems to be a red day, Danny. Let's now bring in Bloomberg Tech's Ed Ludlow joining us live from San Francisco. Ed, you must have been up all night digesting all of this, but maybe we should start with Alphabet. We have Google Cloud booming, but free cash flow turned negative. How do you square those two?
Yeah, I mean, the story certainly changed overnight, right? In the initial print, everyone's like, okay, here's evidence that there's a payoff there, raising Capex to $205 billion at the high end for this year tips Alphabet into negative free cash flow in that quarter, and now the outlook's slightly different. And so even though they posted 82% cloud revenue growth, the story has gone from AI spending is starting to pay off to the price is high for that payoff. And certainly the stock being down 6% on track for its biggest drop, I think, since May of 2025. You know, it's a severe reaction, tells you quite a lot.
I wonder if, obviously different businesses, but if there's something similar with Tesla this morning, Ed, where yes, you can show strength in your automotive business, but when you're spending so much in businesses that are yet to be contributing any profit, is this just a market that's lost its patience?
Perfect summary. You know, record vehicle deliveries in the quarter gone, but higher rates, higher R&D costs, higher stock-based compensation were all in the negative column. Capital expenditures will be $25 billion this year. Actually, if you track 1Q and 2Q, they're not even tracking to hit $25 billion. But, you know, the analysts were really focused on this idea that they're going to have to not just spend money, but spend it quickly. And Musk engaged with that. He basically said, you know what, we don't want to go for sort of super capital efficiency at the expense of being slow. They're willing to move fast. It's that the robo-taxi business had very limited updates. The Optimus humanoid program has updates. The manufacturing lines are going in. There's just nothing tangible to say these businesses are real in the near term, just that they're going to have to spend heavily to get there.
Ed, we appreciate it. And as always, looking forward to Bloomberg Tech at 11 a.m. Ed Ludlow, host of Bloomberg Tech. Let's bring back in Seema Shah of Principal Asset Management. Seema, can we just get your first reaction to the Alphabet earnings yesterday, both the earnings themselves and how this market is reacting this morning with a sell-off in Alphabet?
Yeah, I mean, I think the big news from Alphabet was really about the negative cash flow. And that's what the market is overall is really responding to. It is that drifted narrative from, look, we're expecting all these wonderful productivity gains to come once all that Capex is spent and allocated. Now the question is really about the monetization. What is the return on investment? And that's where I think the real concerns are growing, not just for the hyperscalers, but for the broader tech complex. And I have to say, we are still positive on tech. But as you're seeing this AI cycle mature, there's still so many questions about which of the companies that are going to be seeing the benefits. What are their economics? What is the free cash flow? How does that persist? So this is a point where you really have to be able to discern who are the winners and the losers. I think that's what the market is now reacting to.
So you did say that you're still in for tech, and tech still leads, but where do you see opportunities, maybe outside of AI?
Yeah, and this is a really good point, because there's so many companies out there who, because they haven't been attached to the AI trade, they have almost been punished for not being attached to it, but they're still really, really strong companies. And we do see them across the broad sectors, financial, certainly, banks are looking really good, industrials, healthcare, certainly. There's always going to be really good opportunities, and particularly in this kind of environment where some of them have been punished, there are attractive valuation opportunities. And at the same time, there's also companies in all these sectors who are going to be AI beneficiaries because they're investing and they're going to see the productivity gains. So there's a lot of opportunities out there. The one thing that we do need, though, is for the macro backdrop to stay constructive so that these companies outside of that AI complex can continue to perform well and deliver those earnings.
But Seema, I wonder if even for companies in the AI complex, if that is a problem, because earnings expectations are incredibly high. I mean, this is probably true for basically every company in the S&P 500. So when you get a company that does well, it's not surprising because we expected them to do well. Alphabet's a great example. They do well, but they sell off. Texas Instruments, similar thing last night. Good results, but they sell off. In order for these companies to do really well and actually see more gains, does there need to be an improvement in the macro backdrop? Is that sort of the last thing we can really squeeze out, considering so much of these earnings are already in the price?
Well, so you certainly need the macro backdrop to persist, that constructive backdrop to persist in order for the market to continue almost performing well. I think the vulnerability is higher, though. So, you know, if you don't have the macro backdrop staying strong, then the vulnerability is so high that these companies are going to be punished. And certainly, as you said, the earnings growth forecasts are very, very high. They probably can be met, but the chance of it persisting, so those kind of earnings growth forecasts persisting, is now starting to turn. And that's where the market is also looking for. So what from an AI side you really need, as well as the strong macro, is that monetization. That's where the focus is going to go. And I can't see that changing anytime soon.
How much, Seema, do you think, how much of this bull market is driven by fundamentals versus just all of this AI positivity? Because last week we got that China startup moonshot, really frazzling markets, but everyone seemed to have forgotten about that this week. And I'm really keen to hear in the earnings calls what the executives think about that.
I mean, I think the broad market is still being driven by that very strong earnings. We haven't really seen that much multiple expansion. That hasn't been the story. It's still about earnings. That's certainly the case for the broader market. When you're looking specifically at tech, as we said, it's really, again, it's about the monetization, what is happening to the cash flow. The narrative is changing. So it is still really a requirement for fundamentals. And again, that's why actually the Iran tensions become more and more of an important part of the story, because we still need that backdrop to be strong, supply chain pressures to subside so you don't get the price pressures that could impact margins. We need all of that to go away in order for those fundamental drivers to continue to support the market.
Seema, I was struck, and we're going to hear a little bit of the sound later. I was speaking to John Gray of Blackstone, who came out with earnings that beat expectations, and it's largely around an AI bet. And I asked him, because he's made this argument before, Blackstone is a really cheap way, considering its multiples are that of a financial company, to play AI. And he talked about this idea that eventually the market's going to catch up and maybe rate them at higher multiples. I wonder, when you look at these financial companies, you can maybe even extend this to banks whose deals powerhouse has been powered by AI. If these second order effects are really attractive to you, and maybe financials should start to get more love than they usually do at this point in the cycle, just because their fortunes too have become tied to AI.
Yeah, it's interesting. Financials are a really interesting part of the narrative, because they continue to do well. I mean, their fundamentals have been very strong. They were kind of unfairly beaten up at the beginning of the year because of concerns around rate hikes, concerns about the macro environment. And actually, they performed really well. They've also been considered as a bit of a diversification to the AI trade, because it is on at least some segments driven by other parts. But exactly to your point, they are the beneficiaries of all that IPO activity around the tech space. So I think you can look at it in two ways. Certainly to us, financials, specifically banks, look to be one of the strongest parts of the market going ahead, and certainly an interest for our investors.
Seema, fantastic insights. Seema Shah of Principal Asset Management, thank you so much for joining us on this Thursday. Time now for our top call. Some of the analyst action in focus this morning. First up, JP Morgan slashing its price target on Tesla to $445, pointing to the company's softer than expected gross margins. Next up, we have Goldman Sachs cutting its price target on IBM to $270. You see the stock there falling 2.5%. They're citing weak software growth, a shifting hardware mix, and execution concerns. And finally, we have Wedbush adding Alphabet to its best ideas list. That's an interesting timing. You see the stock there down by more than 6%. It's an outperform rating. They're saying results reinforce its thesis that Alphabet's full stack AI position is translating into cloud share gains.
Well, if you loved Alphabet yesterday, you would love it even more today if it's down 6%. Let's stick with the company raising its Capex plans after another strong quarter. Jefferies tech sector leader Brent Thill says that Google's cloud business is, quote, bursting at the seams. He joins us now. Brent, it is. I mean, 82% year-over-year growth in cloud, the margins at 34.6%. And yet it is an Alphabet that is on track to have its worst day since May of last year. Is there a disconnect here?
Yeah, I mean, Capex and software and internet are not friends. I mean, if you think about them raising Capex by $20 billion, that is an impact to cash flow. And obviously that's going into memory, infrastructure, AI, land, networking gear. So again, this concept that, AI spenders, you want to be out of, and you want to be in the AI spending receiving category. The receivers are obviously out of this AI infrastructure. So again, I think this is why you have semis up 62% year to date. You have software down 16%. You have a mixed bag for many of the hyperscalers, Amazon, Google, across the board, right? They're all the ones that are spending. And remember, there are 5 companies that can build this AI infrastructure, because it's $100 of billions of dollars investments. It's not a single digit or tens, it's hundreds of billions. And Google, Amazon, Microsoft are all going to spend over $200 billion each. So do you want to own the spenders or the receivers of the capital? And the analogy of this gold rush is, did you sell picks and shovels or open a gold store? You made a lot of money selling picks and shovels. Then you made the money opening the gold store. And so today, it just goes back to the ongoing narrative of in my coverage, we cover all the hyperscalers that are spending the money. And that's having a direct reflection. You see the stock down 6% on this concern of the spend. We are so early in this build out that they can't turn back. This concept, is there an ROI? I think there is an ROI. It's just going to take time. And so for patient investors, we think they're going to be in an incredible position. But, short term, this is going to be hard. Everyone's going to ask for the ROI. There are going to be a lot of questions we can't ask in the short term. But long term, we think that this is the right move. And again, you're going to look back in 3 years and say, wow, Microsoft, Amazon, and Google, maybe Meta, maybe CoreWeave pulled this off. And there are not going to be that many others that were able to do this. And the Chinese worry about open source models coming to eat OpenAI and Anthropic. We think all these models will be good for AI. It brings more workloads to these clouds. It means more Capex. And so I think this kind of these fears that come into the market every week and then they change direction. I mean, ultimately, a lot of these concerns are still going to be here a quarter, 2 quarters, 3 quarters, a year from now. And the ROI for AI is really not going to be felt until 2028, 29 in the enterprise. This is just slow glacial buildup. It's not gonna happen overnight.
Brent, you raised interesting points there. The Capex numbers are indeed eye-popping, and Google raised its spending outlook again, and you said investors should be more patient. But how patient should they be? What is your time frame if you must put on that? When should markets ask whether these will actually generate returns?
I mean, these are year-long, 5-year investment cycles, 10-year investment cycles. So again, I mean, look at Google stock from a year ago. Everyone thought they had no AI, and the stock had a huge move. All of a sudden, we go into a quarter, and they're going to do everything perfectly, and that's not the case. So I think the expectation going in is like, the multiple had gone from 11 times EBITDA to 16. It was towards the higher end of its range. Everyone knows how well they're doing. The element of surprise just wasn't there on the core fundamentals. Things were good, but it's being overshadowed by all this expense. So, we go through these moments where, investors are just wondering when the ROI is going to come in. And we've said the ROI is not here till 28, 29, 30. It takes a long time. So if you're a semi and hardware and networking investor, you're seeing these dollars immediately. I mean, Alphabet just raised their Capex by $20 billion. Where's that going? It's going into memory.
Well, Brent, if I can just jump in, because what does that mean as to what you recommend then? Do you wait until you start to see some of those ROIs? Or is the time to buy now when they settle off because we haven't yet seen it? Or do you just sit with the ones who are receiving the checks, that you stay with the picks and shovels until there is more clarity?
Picks and shovels.
So you stay away from the hyperscalers?
Trade is you stay overweight the receivers of the capital. This is not rocket science. Who is receiving the money? It's all infrastructure. The hyperscalers are the ones that are spending. We have buys on Amazon and Google because the multiples are reasonable, and secondarily, they are going to be in 3 to 5 years the big winners. So again, it depends on your duration, but look at from a year ago, Google, you made a lot of money in Google, and everyone's like, well, it's down 6%. How do you make money? You're like, you just made a lot of money. What are you talking about? Like, let's zoom out on the bigger picture here. The bigger picture is they massively win. They are going to absolutely crush their competition, in my personal opinion. So they have the most integrated AI factory. They have this AI ranch that no one else has.
Brent, thank you so much for joining us. Unfortunately, we're just out of time. Going to have to leave it there. Brent Thill of Jefferies. And don't miss Bloomberg Tech. We'll be speaking with another tech leader, IBM CEO. That's at about 11:30 a.m. New York time. Coming up on the show, Blackstone's profits jump thanks to a winning AI bet. Part of my conversation with John Gray, the company's president and COO, on the other side of this break. You're watching Open Interest. Blackstone joining a growing and increasingly long list of companies placing big bets on AI. It reported a 26% jump in earnings in the second quarter. I asked the company's president and COO, John Gray, how much of that jump was powered by AI.
Well, it definitely was a heck of a quarter, Danny, and 26% up in earnings on top of 25% last quarter. And it was definitely powered by that strategic decision we made to lean into AI and the AI ecosystem. It really started for us back in 2021 when we bought QTS, this big data center business, and it gave us a front row seat in terms of what's happening around AI. And we made a strategic decision, hey, we should lean in here, not just with data centers, but with neo clouds, large language models, electrical equipment, energy. And that decision is paying off and it's delivering for our clients, which is the most important thing. And what's also very exciting is we're not done here. Just in the second quarter, we announced partnerships with Google and TPUs, with Broadcom and financing chips, with Anthropic and deploying their technology. We continue to see a lot of opportunity in this space to generate favorable returns. We announced a couple of big sales in the last few weeks, one of data centers for $8 billion. We announced yesterday a battery storage company we sold for $7 billion. So AI and that ecosystem and our strategic pivot has really made a difference for the firm and our investors.
And we'll have more from that interview with John Gray coming up in the next hour as shares turn positive post their earnings, currently up 1.2%. Also coming up in the next hour, Ann Berry of Threadneedle Ventures joins us as markets digest those big tech earnings. All that to come. Stay with us. You're watching Bloomberg. 30 minutes into your trading day. Welcome to Bloomberg Open Interest. I'm Danny Berger alongside Isabel Lee. Matt Miller still on paternity leave. This market, Isabel, selling off after Alphabet earnings and yields that climb higher. And we're going to talk about that on the show. Coming up, Alphabet's spending plans trigger fresh questions about the cost of AI.
And Blackstone is cashing in on that AI boom. We'll hear more from John Gray with this interview with Danny Berger this hour.
And Brent hits $100 a barrel as Houthi attacks in the Red Sea amplify supply risks. We begin with big tech earnings as Alphabet's massive AI spending plans rattles investors. Joining us around the desk is Bloomberg Intelligence Head of Global Tech Coverage, Mandeep Singh, and Threadneedle Ventures founder, Ann Berry. My two favorite people on this earth, so I'm very excited about this. Mandeep, let's just go over the number themselves because Alphabet, especially for cloud, 82% growth year over year. That is such a strong number, and yet shares sell off more than 6%.
Well, because they're raising their Capex, and they talked about raising Capex significantly for next year. So not only did they raise for second half, but they're talking about probably another 50% plus increase for next year. And the market will look at the fact that margins may come down, even though cloud margins expanded significantly. They're talking about renting compute from other parties like SpaceX and other neo clouds. So that may be a slight drag on margins. And then the fact that they are selling their own TPU systems, which is another sort of line of business within their cloud segment now. So all these things are hard to digest, I think, when they're reported. But overall, it was an excellent print and really very strong growth, like you said, on the cloud side with margin expansion.
And I want to bring you in. So Capex spend has been eye-popping. It's like hundreds and billions of dollars. And then we had a guest earlier, Brent Thill of Jefferies, saying that just be patient. But how patient is patient? I mean, investors want to see returns. So when do you think markets will finally get tired of waiting?
Well, I think today's sell-off is a sign perhaps that time frame for patience has started to contract. I mean, to the point we just heard, this was a great print, and yet we're seeing those stocks down. And I think that's the market saying, look, there's a much higher level of price support than we've seen in the past, because we do believe in the underlying thesis. We absolutely believe in the AI, the promise of AI and what will inure to the benefit of Alphabet. But that return on investment, when you're starting to see Capex increase by 50% for projections next year, that sell-off today to me is saying we're not hearing sufficient guidance on ROI to get us comfortable.
I also wonder, Anne, if a lot of what we're seeing this earnings season is just mean reverting on things that have done really well or have sold off. Because I think about Alphabet, up 68% over the past 12 months. Texas Instruments also had really strong earnings. They sold off. And then on the flip side, IBM had missed on their revenue, and they talked about shifting spending. And then they rallied off the back of this. I wonder how much of earnings is just kind of using as an excuse to reset after some pretty big moves so far this year.
I think that's right. And I also just think about sort of my own personal experience. When you see an earnings print like the one we just saw from Alphabet, in any other environment, I would want to go and add that name. I can't. I'm already holding too much of it. I'm already, frankly, over-indexed because of the run-up that we've seen. And so I think folks are using earnings, to your point, Danny, as the moment to reassess. I think there is some profit taking. They're probably not selling these big names as much as they would want to because you're afraid you're going to sell down quality. So you're going to see some recalibration for sure coming out of this.
And Mandeep, there was also Tesla yesterday, and they said they want to spend as much as they can when it comes to AI. Do you view that as a warning or maybe confident? Because we do have investors wanting Tesla to spend more on AI, which is the flip side of the story.
I think to the point about ROI, so there is Capex spend where you can see paths to clear ROI. I think in the case of Alphabet, because it's vertically integrated, you know they'll be using the compute either for their own model or for the cloud business. In the case of Tesla, the paths to ROI is not that clear because if it's robotics related or humanoids, it's like there's not even an evidence of that. So the only thing you can do is to rent compute, which is what they're doing with SpaceX. So if Tesla starts to rent compute, then yes, there is some ROI. But besides that, I don't see a strong case why Tesla has to significantly ramp up their Capex.
Mandeep, forgive me if this is not something you've deeply looked into, but I assume you know everything. I feel like I keep hearing on all these various earnings because in this world where everyone's invested in each other, that a lot of these companies had SpaceX investments. Google talked about their SpaceX investment. Tesla also owns equity in SpaceX. Is this a gift that had been given for this quarter? And I wonder if it becomes a liability as SpaceX rather starts to sell off and continues to trade below its IPO price.
It could, and it's a great point that, Google is a 6% owner of SpaceX. So from that perspective, there's all the more incentive. And even the rental deal that came where Google had to rent compute capacity at twice the market rate was quite surprising when Google has so much of their own compute. So look, we can make that argument, but at the end of the day, these companies will trade on fundamentals. In Google's case, 24% top line growth for a company of this size with stable margins and all this Capex is very impressive, regardless of what happens to SpaceX. So I would say the market will figure out, for these companies to trade on fundamentals eventually.
And taking a step back a little bit, the market is juggling a lot of AI spending, higher treasury yields, and Iran headlines. Which is more important to you? I feel like Danny and I are like headless chickens. Like, where do we focus? Every day there's something new.
I think it's going to depend on the near-term visibility of each of these. So let's take Iran. I've been surprised by the relatively tame volatility in the markets in reaction to such a profoundly important geopolitical event globally. And I think the reason is there's been constant faith and confidence that that situation is going to be resolved. And the White House has frequently come out a lot to say we think this is going to be resolved. If it looks like there is truly no end in sight, I think we start to see more intense reactions. We're finally starting to see oil react today, breaching that $100 level in a way that you'd expect much more than we've seen over recent weeks. So I think the intensity and the faith and confidence that there's resolution. Tech, to me, though, is still going to be the overriding one. There's so much sentiment around tech. It's overriding the yields trade, in my opinion.
I also think one of the interesting ideas you have, theses, is around entertainment. We're just coming off the back of this incredible sports summer, which I personally am depressed that the World Cup is over, the playoffs are over. I don't know what to do with myself.
The US Open's coming. The tennis is coming
That's a
to your
very good point.
I just
need to wait 1 month, and then I'll be okay. Thank you all. This makes me feel a lot better. This is good therapy. How are you looking at expressing that through equities themselves?
Yeah. So, and I've talked about experiential a lot. I've done this on the private side in venues and music and a women's basketball league. And so there's two I'm looking at. Sort of invest what you know. I was at the Sphere. I saw the Backstreet Boys. I've said it out loud. I know, and they're back. And look, the Sphere was packed. And look, I've looked at this. Frivolity aside. side, that is trading at a decent EBITDA multiple. There's a real thesis to sort of grow Abu Dhabi. We're getting more clarity on that. So I'm sort of adding something like that. Every seat is full. Vegas has struggled. The Sphere's done really well. And then there's another company called Navan, which is new to me. I just met the CEO. And I sort of wrote in my notes, when I prep for these CEO interviews, it's always more interesting if there's something jazzy going on at the company. This one just has straight across the board buy ratings. It's got fantastic growth, and it's basically a corporate travel expense software platform. AI is meant to be eating the sector alive. Instead, all the big names, Anthropic and OpenAI clients, and it's just gaining share at a rapid clip. To me, it's the travel sector stock I'd never heard of.
So with all of that, and even Danny's sports love, sports aficionado.
Yeah, sure, I'll take all of them.
Yes.
All the adjectives.
Talk to us about consumer spending, because I feel like, again, I've heard this so many times, I'm tired of talking about it, but it's real, the K-shaped economy. And some investors I've talked to said that the upper K actually is feeling a little bit stretched too. But then it seems like when I look at all of these sports, people are there. My friend just watched the
World Cup final?
The sports thing.
I know you weren't there.
The World Cup final, and I'm sure it cost thousands and thousands and thousands of dollars.
Oh, I can confirm it cost thousands and thousands of dollars, because I was sitting there watching the England-Argentina game, pressing refresh on Ticketmaster every 2 seconds as that game advanced, sadly, to the outcome that it did. Look, I think it is indicative of the K-shaped economy that you've got people who are willing to spend that kind of money. You're seeing it with the airlines saying that premium travel is proving very resilient, even as oil prices are pressuring their cost structure. And I actually think with these kinds of experiences, music tickets, these are high ticket prices, but for higher income demographics, they're the version of affordable luxury. There are a lot of people in America who can afford several $100s to go and see a live event. Different in the thousands, but there's a lot of people who can still do it in that hundreds range.
I still want to stay in the arena of demand, but bring this back to tech, Mandeep. One of the things I was thinking about, I mean, we can make whatever analogy you want to with the consumer, but whether demand for AI is elastic or inelastic, do we have any sense, as prices keep rising for some of these services, whether corporations, whether enterprises are still willing to pay up?
I mean, look at how much of a pivot these companies have made, especially OpenAI. They were all focused on consumer side, ChatGPT subscriptions, and suddenly it's all about coding agents and enterprise opportunity. And these companies have figured out that's where, there's a lot of willingness to pay up. And all of them, even Google, which is trailing in terms of their coding agent capabilities, talked about how much they care about catching up to frontier models in terms of coding agent functionality, which is just one part of large language models as a whole. So from that perspective, they will pivot more towards enterprises. I mean, OpenAI shut down Sora. Why? Because they couldn't find any ways to make money out of that. So I think you will see, given how expensive this technology is, it'll be focused towards enterprise use cases where the tokens can be monetized, and that's where all of that spend would go.
Thank you both so much for joining. This has been such a joy. That's Ann Berry of Threadneedle Ventures and Mandeep Singh of Bloomberg Intelligence. We are about 40 minutes into your trading day. Let's get a look at this market. It continues to sell off. Pressure coming twofold. One from Alphabet earnings, as we've just been discussing. All of the eyeballs focus squarely on their capital expenditures, which have been growing quite steadily. So tech selling off more than the rest of this market, down 1.5% for the NASDAQ, S&P down about 78 points. 10-year yields up 5 basis points. The front end of the curve looks something similar as we price in more than 40% odds that we will get a hike in next week's meeting. Part of the problem is what's happening in the Middle East, and the price of Brent crude up 7% as there continues to be disruption, not just in the Strait of Hormuz, but the Red Sea as well. We'll have an update from our Tyler Kendall in just a moment's time. First, though, let's look at some of the single stocks moving this hour. IBM cut its full-year sales outlook after seeing a dip in demand for its mainframe business, but some analysts say, Isabel, that the report was better than feared.
I guess it's better than feared, but then you see the stock still in the red.
It was rallying earlier.
It was, yes,
just for what it's worth. I said that earlier, and it was up when I mentioned it. Just want to point that out.
We will find out more from IBM CEO on Bloomberg Tech at 11:30 a.m. New York time, because that's really going to be interesting. We're also looking at Uber cutting 10% of its customer service jobs, citing a broader effort to simplify its ranks and, quote, embrace AI. The stock there down softly, 0.6%.
Meanwhile, American Airlines Airlines lowered its outlook for the second time this year, sending shares down nearly 8%. Fuel prices still high for them due to the war in Iran. We're going to talk more about American later in this hour.
Coming up, Brent edges higher now in the 3 digits as tensions escalate in the Middle East. That's next. This is Bloomberg Open Interest. Now to high interest, a look at what's making headlines around the world. SK Hynix, again, it's back. It's limiting the amount of South Korea listed shares that can be converted into U.S. traded ADRs at 2.5% of total shares outstanding. SK Hynix ADRs have traded at premiums to the Seoul listed shares, and the new cap raises the possibility that the gap could remain wider for longer. And we have OpenAI's advanced AI models hacked into Hugging Face internal systems in a matter of hours. Sources tell Bloomberg that the hack would have taken a skilled human a couple of weeks to complete. OpenAI has been in contact with the U.S. government since learning about the breach. And the Iran-backed Houthis have opened a new front in the Iran war. The militant group said it struck 2 Saudi Arabian oil tankers in the Red Sea with missiles and drones. The attack could effectively close another maritime choke point vital to energy markets, with oil prices rising even further as a result. We have President Trump saying that the U.S. will hold Iran accountable for future Houthi strikes.
Isabel, let's now get to Bloomberg oil strategist Julian Lee, who joins us now for more. Julian, what do we know about the ability of ships currently to traverse through the Red Sea, and just how dramatic of an escalation and an issue is it for these oil markets?
Well, I think it's quite clearly a significant escalation. This is the first attack by Houthis on shipping in the southern Red Sea for several months now. They clearly warned that they were going to do this, and they have followed through. On the other hand, we have seen 2 Chinese-owned tankers full of Saudi crude that are at this very moment passing through the Strait. They appear to have crossed the narrowest point, and they're now entering the Gulf of Aden on their way out to the Arabian Sea. Now, that doesn't yet put them out of the danger zone, but it does seem that at least some ships are being allowed through, and we're yet to fully understand how selective the Houthis are being in terms of what they target. But this Red Sea route had emerged as a vital workaround to the effective near total closure of Hormuz. Saudi Arabia had redirected somewhere in the region of 4 million barrels a day of oil exports from the Persian Gulf to the Red Sea. Those are now substantially at risk. And what really matters is less, how many tankers are attacked, but what the impact is on the owners and the crews of ships that would normally pass through that waterway, and whether they are willing to still take that risk. And that is the only real measure of whether the waterway is open or closed, no matter what politicians on either side say.
So, Julian, if both the Strait of Hormuz and the Red Sea get disrupted, how high could oil prices realistically go?
Well, I mean, we've seen forecasts and analysis from some of the big banks talking about oil at 120 and sticking up around that sort of a level. We've already seen Brent break through $100 a barrel today. So, what I think is clear is that the market is very concerned about these choke points. It's very concerned about the amount of oil that may or may not flow through both Hormuz and the Bab el-Mandab at the southern end of the Red Sea. And that is going to keep pressure on prices for the time being.
I just wonder, Julian, and again, I saw that note from Goldman about $120 in oil prices as a possibility. We did have that earlier in the year when this conflict first erupted, yet we did see the market pull back on demand. Is there any idea now that we understand maybe demand for oil is more elastic than we originally thought, and this market can cope with less barrels of oil on the market?
Well, certainly a sort of pullback in demand was part of the way that the market coped with the initial disruption that began in March. And we've certainly seen a reduction in consumption, most notably in China. But I think the other thing that we have to remember is there has been very significant drawdown of stockpiles to also help contribute. Those stockpiles, yes, there is still oil in both commercial and strategic storage, but there's a lot less than there was at the end of February. So, you know, unless you start replenishing those stockpiles, you can't keep drawing them down forever. And I think the other, you know, the other issue that is going to contribute to upward pressure on prices is what's happening in the Black Sea. We've seen attacks on tankers waiting to load at the CPC pipeline. That's about 1.5 million barrels a day of oil, most of which comes from Kazakhstan, and an awful lot of it is produced by American companies. But that pipeline has, for the moment at least, halted. So on top of Hormuz and the Red Sea, we've got these issues in the Black Sea as well, which are all adding to this pressure.
When you zoom out, Julian, do you think we're entering an era where geopolitical risk is permanently reshaping global oil prices and the shipping routes in the world?
I think what has happened in the last 4 or 5 months has been a clear illustration of just how much we depend on these very narrow waterways and how easy it is for the states on the shores of those waterways to severely limit traffic through them should they want to. So that clearly raises, I think, everybody's understanding of the geopolitical threats. Will things calm down again? I'm sure in time they will, but when that time will come, I think is a much more open question at the moment.
Julian, thank you so much for joining us. We appreciate your time. Bloomberg's Julian Lee. Still ahead on the show, Blackstone's profits get a boost from its AI bets. We're going to hear more from John Gray in just a few moments. This is The Open. Welcome back to Open Interest. Nearly an hour into your trading day, and it's still a punishing session. It's being led lower by tech. So there are two things we have to go through for this market that is weighing on sentiment. For one, it is Alphabet earnings with a huge amount of Capex, $200 billion, an upgrade there at the high end. That does have investors worried about the return on investment, even though cloud revenue was up 82%. So NASDAQ leads losses down 1.5% versus 1% for the S&P, 0.6% for the Russell. Part of the other problem, though, and one of the reasons small caps aren't immune to this is because of what's happening in both oil and yields. We were just talking to Julian Lee of Bloomberg about this, that the Red Sea is now facing turmoil, 2 attacks from the Houthi rebels. Brent crude back at $100 a barrel, the first time since May that we've seen that. 2-year yields also weighed not just by oil, but also jobless claims coming in at their lowest since '86. The doves flying away, 2-year yields trading at the highest since 2025. So I mentioned Alphabet, Tesla, also tough earnings yesterday too, not showing up for these big dreams that they have in terms of the robot and autonomous vehicles and robo-taxis rather. IBM slightly higher, but this thing is already trading at a 2024 low. It cut its earnings expectations for the year. Intel, we're going to hear from after the bell. Lockheed Martin, RTX, both of them showing strong results. A lot of geopolitical tensions means that countries around the world are boosting defense spending. Coming up, we'll speak with John Gray, President and COO of Blackstone. Blackstone reported a 26% jump in second quarter profits, driven by strong investment exits and gains from AI. I spoke with President and COO John Gray about what's fueling that growth. Let's start with the big beat, really strong numbers this quarter. John, just how much of that, can you give us an idea, was powered by an AI wave?
Well, it definitely was a heck of a quarter, Danny, and 26% up in earnings on top of 25% last quarter. And it was definitely powered by that strategic decision we made to lean into AI and the AI ecosystem. It really started for us back in 2021 when we bought QTS. this big data center business, and it gave us a front row seat in terms of what's happening around AI. And we made a strategic decision, hey, we should lean in here, not just with data centers, but with neo clouds, large language models, electrical equipment, energy. And that decision is paying off, and it's delivering for our clients, which is the most important thing. And what's also very exciting is we're not done here. Just in the second quarter, we announced partnerships with Google and TPUs, with Broadcom and financing chips, with Anthropic and deploying their technology. We continue to see a lot of opportunity in this space to generate favorable returns. We announced a couple of big sales in the last few weeks, one of data centers for $8 billion. We announced yesterday a battery storage company we sold for $7 billion. So AI and that ecosystem and our strategic pivot has really made a difference for the firm and our investors.
Just on that pivot, John, I was really struck last month. You were at a Morgan Stanley conference, and you made the case that Blackstone is one of the least expensive ways out there to play AI today. Blackstone, of course, trades more akin to financials, multiples that look like that. Do you think Blackstone should be trading at tech multiples? Should you look more like an NVIDIA or an Alphabet?
Well, what I would say about Blackstone is we're a company that operates with virtually no capital. We don't have any insurance liabilities. We have virtually no debt. We've shown incredible growth. Look at our earnings in the first half of the year. Today, we're yielding 4%, which is one of the highest dividend yields in the S&P. And yet, when we look out over the horizon, we see real growth potential. We see it with our institutional clients, with our insurance companies, and with individual investors. And today we're trading at a discounted market multiple. Yeah, we see it very differently. But I think as the market begins to see the earnings power of this firm and what we can deliver as we grow, as we generate these great returns from the strategic pivot we've made, I do think the market will change things, so re-rating will come. Sometimes we've got to be a little patient. The key for us is just keep executing.
I guess what I'm trying to understand is just to what degree Blackstone has been made into not just an asset manager, but a pure AI play. And John, a lot of people might look at that and get concerned that you've bet the house on one theme. How do you assuage investors who might be concerned about just concentration risk in AI bets?
Well, we've got a big, diverse firm. Obviously, we've got a very large real estate business. We invest in secondaries. We're in the hedge fund space. We have all different forms of credit out there. Our private equity business owns lots of regular way businesses like Jersey Mike's. So there's more to this firm than that. But I think the decision here to lean in when you see this huge shortage of compute that is out there and an opportunity to earn favorable returns by aggregating capital at scale, having terrific platforms, to me, that makes a lot of sense. So there's more to this firm. By the way, it's a global firm, as you know, as well, with big strength in Europe and India and Japan and around the world. But I feel very good about what we've done in terms of this concentrated focus, because this really is a new operating system for the world, and you want exposure to it. It would be a little bit like, hey, I don't want to own the S&P 500 because there's big exposure to technology, growth, and AI. I think for us and our investors, we want to deliver that premium return.
By the way, there has started to be somewhat of a market pushback on just the amount of Capex that's being spent by the hyperscalers. Many hyperscalers you've partnered with, you can see it in Alphabet results this morning, fears over just that big chunky number they announced in their spending. If those hyperscalers do start to pull back because of the market pushback, how does that impact Blackstone's investments and deployment?
Well, that's not what we're seeing today. In fact, it's the opposite. If you look across our data center platforms, we leased 1 gigawatt in 2024. We leased 2 gigawatts in 2025. And this year, we're on pace to lease at least 7 gigawatts, we believe, which is more than 100 billion of data centers and a couple multiples of that in terms of chips that go inside. If there is a slowdown, then yes, the pace of development would slow. The good news is you're not speculatively building. And I think that's really important. When you think about the telecom boom in the 90s, where people built fiber, something like 20 times more than was actually needed. In this case, we're only building to demand and long-term contracts from very large creditworthy companies. That's really the focus for us. And to us, it seems like a disciplined way to do this. I think fundamentally what people aren't getting is how powerful this technology is at companies. We're beginning to see real-time examples, certainly in customer service, in coding. It's now starting to move to the revenue generation side, where businesses are creating new lines, new revenue streams using this AI. And I think because this tool is so powerful, there's an underestimation of what's happening. We see the power of it, and we're really focused on helping meet this compute shortage.
Well, John, because you use the tool every day too, both at Blackstone, I know, and in your portfolio companies, and you have partnerships like Anthropic. I got to ask, though, there's a lot of fear and perhaps excitement around Chinese open source LLMs that they're cheaper, they're more efficient, and they're just as good as the most advanced models. Have you guys tinkered around with any of them at Blackstone, and would you ever use a Chinese open source model?
Well, yeah, I'm not the tech expert here, but our team has worked with a bunch of different models. I think the bigger issue, whether it's Chinese or American, is will there be a range of models? I think of it almost like automobiles. Will there be very high performance, more expensive, in this case, frontier models? Will there be more regular sedans? I think there's going to be both. And I think what you go back to is, as you bring down the cost of compute, if you can bring down token costs with open source, open weight models, what that's going to mean is there's going to be more demand. That's that Jevons paradox idea. As cost comes down, usage goes up. So again, that will put more pressure on energy needs and data center needs, and that will mean more physical investment. I also think, by the way, another area people are underestimating is what's going to happen when this technology gets deployed in the physical world. We're going to have more autonomous vehicles, robots, defense, space. That's going to require further investment dollars. So I think bringing cost of compute down is helpful, but I think there'll be a range of models for a range of needs.
It's almost as if maybe you were listening to Tesla and Elon Musk yesterday on their earnings call too, John. Can we talk about the non-AI investments? I know, as you say, Blackstone is large, it's global, it has other things. Clearly, you've had some excellent realizations this quarter driven by AI. What about everything else? Because the thing this market had been worried about wasn't AI, it was being able to exit the more traditional companies, maybe ones that were bought in 21 and 22 when multiples were quite hefty.
So what we've seen is really a bifurcation. If you leave AI to the side, what we're seeing in terms of liquidity is for traditional, let's call it AI unaffected businesses, there's pretty good liquidity out there. If you're a medical supply business, if you're a fast food chain, people want to own those kinds of businesses. We're now seeing, even in the real estate market, the logistics area, as people see the strength, given the lack of new building there. We're seeing some large M&A potentially with Prologis in the UK. So there is interest in the real world away from sort of the AI trade. I think where it's harder to get liquidity is where there's more uncertainty around the future. So that is in professional services, information services, software, where people are saying, I don't know what this company is going to look like 5, 10 years from now. Now, in many cases, these are great businesses. They're deeply embedded. They will become agentically forward, and they'll succeed. But for now, multiples have come down, and you're seeing less M&A, less financing activity, less IPOs for these businesses. I think that's going to stay for a while.
That was my conversation with Blackstone President and COO John Gray. Isabel, it's so many companies, and really in the financial sector, whether it be private capital in the case of Blackstone, or even these banks who've seen their fortunes explode because they are doing more things tied to AI, whether it be lending in the case of both of them, or even market volatility around AI has been hugely helping financials too.
I was smiling when you say fortunes explode, because it's true. I mean, the numbers we're seeing are just unimaginable. And then I'm still so struck by Alphabet falling when they announced that they're spending more on AI, because everyone's like, where's the fiscal discipline? I mean, we're going to see Microsoft, Meta, and Amazon next week, and are we going to see the same reaction?
I brought that up to John Gray, as you heard, saying what happens if these giant airlines pull back, and he's like, that's not what we're seeing. We're seeing them continue to spend. And to be fair, Brent Thill from Jefferies also saying to us, they can't pull back. They are too far into this project.
You also ask about the Chinese AI startup because like it's almost like, do you spend more to keep up with them or do you spend less because they could do it for less? So, I mean, maybe you just can't do anything right.
Or you open up your own model like a Gemini and have an open source model too. Speaking of which, let's get a look at some of the single stocks moving at this hour, because we do have some of these companies that have been reporting. Actually, we'll do that in just a second. Let me show you what markets are doing. We are declining more on the NASDAQ because of Alphabet, down 1.4%. Yields continue to creep higher. Year-to-date highs for your 10-year yield with Brent crude over $100 a barrel. Okay, now for single name stocks. T-Mobile posting revenue that missed expectations, seeing a modest gain in subscribers, giving up some of the post AT&T highs that it experienced yesterday after those earnings.
And we have Google saying it holds $94 billion in SpaceX shares. This is the great point that you brought up earlier, Danny, that a lot of these companies hold SpaceX, and this comes after the IPO. So SpaceX is also preparing to attempt a major test of its massive Starship rocket later today after abandoning the takeoff last week. You see the shares there just down by around 2%.
But they have fallen, again, that's 17% under their IPO price, so it continues to be painful for SpaceX.
Oh, gosh.
Elsewhere in the real world, or down here on Earth rather, Harley-Davidson delivering disappointing motorcycle sales. Its price cuts didn't attract as much interest as analysts had expected.
Coming up, we have box office blockbusters boost Comcast second quarter. We take a look next. This is Bloomberg Open Interest. A major milestone for Comcast, the company reaching profitability with its streaming platform Peacock for the first time ever. Second quarter results also got a boost from the box office success of the Super Mario Galaxy movie and Obsession. I have not watched either of those, Danny. I'm really
You're not a horror fan?
showing
I think Obsession is horror.
Yes, no. But here with more is Bloomberg Intelligence media analyst Geetha Ranganathan. Geetha, thank you so much for joining us. So if Peacock finally turned a profit, do you think that's the story, or do you think investors are still more focused on their broadband losses?
Yeah, unfortunately, Isabel, for them, Comcast just doesn't get a whole lot of credit for its media outperformance. Investors still super focused on the broadband side of the story. Remember, broadband generates 85% of the EBITDA at Comcast. And really, this has been a real tough slog for them over the past so many quarters where they've been losing subscribers. Remember, they are the largest broadband provider in the US, but they've been losing subscribers at, an accelerating pace. And there's just immense competition. The marketplace is very, very intense right now, both from the telecom providers. So you have fiber and fixed wireless, but you also have a new emerging competitor in Starlink. And that is causing a lot of nervousness for the long-term growth outlook.
Have some of their big and expensive sports bets played off, whether it be the NBA or the Spanish language programming showed on things like Telemundo and Peacock for the World Cup?
Yes, huge. In fact, one of the big reasons why Peacock was profitable and, gained a good, healthy number of subscribers in the past quarter was actually because of the NBA playoffs and, the Spanish language programming for the FIFA World Cup. Also, not to miss, Love Island USA, their most streamed program. So that was another huge contributor. But Peacock really has made this bet on sports. It's a US-only product, so it's a little bit difficult to compare it with the rest of the streamers. So scale and scope is still a little bit limited. We have only about 50 million subscribers or so versus like the 300 million at Netflix. But they've done a pretty good job right now in terms of at least turning it profitable.
I have not watched Love Island?
Love Island.
Have you?
You're missing something.
I used to watch the UK versions when I lived in London, and they are so good. I kind of haven't watched it recently because I don't know. I'm an adult and don't have time to watch an episode every single day that they put out. But yeah, again, very popular, to Geetha's point.
I should stop talking because I'm highlighting how boring I am. But Geetha, the park business also disappointed. Do you think that is a one-time issue, or do you think that's a sign that people are really pulling back from travel?
Yeah, so, their parks business has actually taken off in a huge way over the past year, Isabel. So they opened a new park in Orlando, Epic Universe, which has performed extremely well. And they're making investments all across the world. So they've opened a new park in Texas. They're actually making this huge investment in the UK. And they're making these investments, and it is paying off. That said, they did point to some softer attendance trends in Orlando this quarter. They said it's, in June actually, and extending into July. It's a bit of macro concern, so hopefully it goes away and it's not something that is, more long-standing.
And maybe kind of in the background of all of this, Geetha, which I know is something that you've been discussing and writing on, is the separation of these companies, of NBC Universal and Sky. How is M&A clouding or complicating their landscape?
Yeah, I mean, the whole idea of the spin here was to really highlight the value, Danny, in the media assets. I mean, we've seen over the past year this whole frenzy for, media assets when it came to the Warner Brothers bidding war between Paramount and Netflix. And that, I think, has kind of really emboldened them to say that, okay, NBC is a superb collection of content assets. You have a great studio, Universal, you pointed some of their recent successes, and of course now the Odyssey. And then you have the theme parks business and you have the streaming platform, but we're not getting credit for it, right? Because, it's unfortunately being clubbed together with the cable assets, which have really seen their valuations fall tremendously. And to that point, they're separating it out. Hopefully, I think they're banking on some kind of an M&A deal, hopefully with Netflix, Apple, we really don't know. And that's what should get investors cheered. Now, that spin is supposed to happen sometime in 2027, so it's still a little bit of a wait and watch. But hopefully the story gets more exciting.
Geetha, it's already exciting between Love Island and all the sports. Still something to talk about there. Geetha, thank you so much for joining us. Geetha Raghunathan of Bloomberg Intelligence. Coming up, another earnings report. American Airlines lowering its 2026 guidance for the second time this year. More on their challenges. That's up next. American Airlines cutting its outlook again as fuel prices remain high due to the war in Iran. The warning also comes as key rivals show signs of resilience. Joining us is Bloomberg's chief global aviation correspondent, Sid Phillip. Sid, what is the issue for American Airlines? Because yes, higher oil prices and fuel costs, but Delta is facing the same thing, and it reported still robust demand.
So, Danny, the American Airlines problem is the fact that they sort of don't fit into either bucket for value customers or for the premium customers. And they've been trying to attract those premium customers who are unfazed by higher prices and who are willing to pay for premium experiences at a time when those prices are going up. And so for the airline industry, you either need to get into the top end of that K, which Delta and United have successfully positioned themselves in and are able to sort of try and get those higher prices, which help them offset those higher costs. I mean, Delta and United are struggling with higher fuel prices. I mean, they have talked about some margin shrinking, but at the same time, they're in a much better position than American Airlines.
So then, Sid, what does it mean for American Airlines? Should they even try to compete for those premium clients or customers, or should they just find their own segment elsewhere?
So the airline has been talking about how they are looking to attract more premium customers. They've talked about how they are upgrading their aircraft. They also talked about how they've sort of partnered on credit cards that allow them to tap those higher paying customers. But so far, it isn't. We're looking at signs to see where those customers are, but we haven't really seen those customers showing up meaningfully in their results yet. And we will look to see if that will actually change as they go forward.
So, Sid, elsewhere, you've also been looking at some of these defense firms that have reported earnings, both RTX and Lockheed Martin. Both of them are having huge results and share reaction prices. Look at that, Lockheed Martin up 11%. We knew that there was more demand for defense. We've heard it from all these countries that are dealing with two hot wars in Europe, one literally in Europe, the other one on their doorsteps in the Middle East. Why did it seem like such an upside surprise, the numbers they got? Just how big of an outperformance did we hear in their earnings?
So I think for the defense primes like Lockheed Martin and Raytheon, we're seeing a sort of continued demand. I mean, the US has talked about replenishing their interceptors and missiles And so that's been something that both these defense primes are poised to gain from. We've also seen talk of much higher defense spending, and that's sort of translating into much better sales. Both Lockheed and RTX talked about how outlook for sales is better, and they've upgraded their outlook for sales again this year. And so it does look like for the defense primes, what's sort of hurting the airline industry by higher fuel prices, for the defense primes, that's actually helping them because of the war that's ongoing in two hot wars at the moment. That's sort of really helping defense business cases.
Sid, thank you very much. That's Bloomberg's Sid Phillip on the latest earnings in airlines and aerospace defense. Let's get a check on your markets this morning because it is impacted by earnings. The Nasdaq now at a low of down 2%, with the S&P down 1.25%. Semis are also down, but it's yields that are the other thing weighing on this market besides Alphabet earnings. 2-year yields now up 6 basis points. 10-year yields also trading at a year-to-date high, up 5 basis points as well. Part of that is due to oil, Isabel, up at $100 a barrel.
That oil is really striking to me because it'll also stoke inflation fears, and we're back again about that resurging fears of inflation. Our guest Anne Berry earlier said that she was initially shocked by how much oil didn't move, but then I guess now we got what we wished for.
Now it's moving, and you had jobless claims coming in at the lowest in 69, all of that resulting in maybe a live meeting from the Fed next week. First, coming up tomorrow, Marta Norton of Empower, Maria Waitman of State Street, and the CEO of SGX.